All right, so Karl Jackson, Justin Francis, Leon Aloya, here chopping with two guys that are in the tax optimization realm. One from, I will call Karl, much more of global, universal, all business. Justin, much more focused on the real estate side. But tax optimization is one of those few things that I would say when you look at investments and how we teach economics, there's a small percentage of folks that actually get into the tax side of the business. But when you look at profitability drivers, that tax optimization is one of the large ones, especially when you get into a mature business. And so I wanted to take the time while we have both these guys here in San Diego at the Well House to share some knowledge when you think about how you grow into this space and figure out ways to maximize wealth, tax, real estate. What are some nuggets that we can learn from? I heard earlier today when you guys were discussing the difference between a real estate professional that is doing everything else but short-term rentals, and how utilizing accelerated, what's the word I'm looking for? It was a bonus.
Bonus depreciation.
Bonus depreciation. Explain a little bit about that conversation and how those nuggets can help somebody like myself having an Airbnb here in San Diego.
Now, that's a great question, and it's funny, like a lot of wealthy people and people in the real estate game, because you're so focused on making money and doing deals, you don't have the time to go in and research every avenue of tax credits or how do I maximize my deductions. So it's always good to have a good tax advisor on your team that can assist. So you've been blessed, like, man, like knowing people in the field, and you ask a lot of questions. So
right.
One, first of all, be inquisitive about your situation and try to find out what works. What are the potential opportunities out there for you, especially as a real estate professional or someone that owns real estate. And when I say someone that owns real estate, you may not be a real estate professional, but you still have maybe 1 or 2 rentals or maybe 1 to 5 rentals, but it's not your main job.
You spend more time and more dollars, like on a W-2 income.
Yeah.
So you're not considered a real estate professional from the standpoint of being
that's
able
your
to get
main
right.
40%. But are you considered a passive
investor?
investor?
You are, exactly. So, and that's the crux. So first, rents, royalties, interest, those are passive activities, and losses that are generated from those activities are passive activity losses. So the tax code, Congress feels like there should be limitations on how much of those passive activity losses can go to offset your active income or your W-2 wages. So there are phase outs, but if you're not a real estate professional and you have passive activity losses, then you can take advantage of a total of about $25,000 worth of passive activity losses. Let's say if your passive activity losses were $100,000 and you haven't met the income threshold, then you can take advantage of $25,000 of those, which is fantastic. However, you still living in $75,000 on the table. So I would say try your best to become a real estate professional or have your spouse so that you can maximize your deductions.
And let me ask you this too, because I think that's a real nugget. That's the real nugget, right?
Somebody.
Right. I'm just saying, if you're in a situation, Karl, where you make so much income on your W-2 and you may have a stay-at-home wife, what you're saying to be good to exploit that and really use it so you can get the bonus depreciation if you do it in the right manner.
Absolutely. And that's funny. So one of Leon's other colleagues took it and ran with it. She became a real estate professional and is now like doing hard money lending because I gave her the advice: become a real estate professional so you can take advantage of.
And she went on full on.
She became a real estate professional. I was like, okay,
that works.
Go for the gusto. But for those that don't have that flexibility of having a spouse or you don't have the time, now there's one carve out in the temporary regs for the passive activity losses. So if you own a rental property, and it's a short-term rental where the average number of rental days per customer is less than 7 days, and this is in the temporary regs, and hopefully it becomes permanent, but those activities are not considered passive. Mm-hmm. So for those who have Airbnbs and Verbos, that's fantastic. So, but why is that important? It's important because going back to what Leon first mentioned, which was the bonus depreciation, is that you need to maximize that first year deduction, or when you discover that this is possible, that you can take advantage of deducting more than what's allowable under the 27.5-year depreciation convention. So typically that's what real estate, like rental, like residential real estate, subject to the 37.5% or year convention. Commercials, you can depreciate over 39 years. So to avoid having to depreciate $1 million over 39 years or 27.5 years, you can do a cost segregation study. And so this is why the bonus is important, because you have to do the cost segregation study first, which you're gonna require an engineer to come out, look at your property, and break it down to the nuts and bolts. And you're gonna have to depreciate every nut, bolt, light switch, the electrical system, the HVAC system over its useful life. To the extent that a piece of property's useful life is less than 20 years, then you can deduct currently 80% of that amount that you paid for that in this current year. If you acquired the property and placed it in service in 2022, then you can deduct 100% of that amount, and that's being phased out until over the next 3-4 years.
So if you're using numbers in that same example, where I do a cost segregation study on called $1 million home that you're using for short-term rental, and you might also have a W-2 income that you're trying to offset a big tax liability. So you're saying that because it's less than 7 days average, tenant occupancy, now I could be considered a real estate professional. As a real estate professional, now with the cost segregation study, I can go in there and let's assume that what I might get called 30% of that facility to be considered depreciatable within, call it, this year. So now all of a sudden, instead of me having to wait 29.5 years to depreciate this, I can get all of that in 1 year and be able to offset, so call it, I don't know, maybe it's $200,000 or $300,000 worth of taxable income that I can offset.
No, I agree. So with one caveat, the short-term rental rule doesn't make you a real estate professional. It's an activity that's not considered passive.
Okay, I got you. Okay.
Therefore, the losses that are generated from it are active.
Okay.
So you're treated just like a real estate professional would be. So
yeah, the math is the same.
Yeah, exactly. It's the same. So, but the active versus passive test is the threshold question. And then if you're not in the short-term rental space, then the next question is, am I a real estate professional?
All right.
So that's the logical questions that you want to go through. Like, how can I get to active losses?
Right.
Can I satisfy short-term rental status? If not, can I be a real estate professional? If not, can I maximize the $25,000 that I'm entitled to this year? So,
yeah.
So and the answer to that question is yes. So if you buy a property of $1 million, let's say the land is worth $350,000, and the structure is $700,000 or $650,000. Your cost segregation study engineer is going to come through and break it all out. They're going to break down the building to its component parts, and they may say, $400,000 is attributable to the personal property, and the rest is the structure.
Right.
So the personal property can now be that $400,000 component can be depreciated 100%.
Right.
So now you can, or actually, as of last year, 80% this year. So you get a $320,000 deduction this year, right? Because of bonus depreciation.
So that's a needle mover.
It is, because you borrowed $800,000
exactly,
and you got a deduction of $400,000
right away. That first year. What I don't understand, Karl, is like why most like Barubu and Airbnb owners don't know about this, like, or the possibility of this deduction, because this has just came on pretty recently in terms of Barubu and Airbnb, and people are just doing their own homes, or they're buying something to do it, and it's just not known.
Yeah, I mean, it's just like, bro, it's the same reason why a lot of people don't know how to, get into the tax credit space. It's a barrier. Knowledge is a barrier to entry, unfortunately.
Yes, it is.
So you gotta pay for it. You gotta pay for somebody like me to give you the advice,
right?
Or maybe your CPA has done his homework, and fortunately, you have a good CPA that does his homework, and you got that advice from your CPA, which you should. But oftentimes they're so focused on compliance, right? So they need someone that's reading the regs, because that reg is a temporary reg. It was
Right.
drafted within the last 5-6 years.
Right.
So, you know, people don't read those regs, and it's deep in there. So that's what I do for a living, right? So you have to find a tax professional or someone that can really be your advisor.
Yeah.
You're an advisor.
That's
You don't need a
exactly what it is.
compliance person.
Right.
So now
Yeah.
talking about advice and some of the stuff that Justin does where folks are corporations probably mainly with large tax liabilities are looking at shedding some of that liability or optimizing, I should say, in ways where they're investing in programs. In this case, it's low income. But those kind of programs that can get them the ability to optimize their own tax liability. So when you're providing that type of advice to clients, how are they taking to things of this nature where it's a vehicle? Maybe they weren't necessarily looking at it as an investment that they were going to do in this budgetary year, but now you're seeing that, look, you know, why not bring that forward and reduce? How are you using that, or I would say things like that, within your advice that you might be giving to corporations or whatnot that will be buying credits for Justin's projects?
I think he's asking, like, how do you attract tax equity to these projects?
Yeah.
Like,
You know, I
what-
think
yeah.
tax equity attracts itself only because some of these big institutions have a humongous tax liability. And another thing they get off it is good publicity.
Yeah,
Now, I'm
that's a
sure
good
you
point.
guys all heard about Amex and some of these bigger institutions saying they've produced, 25,000 houses
Right.
throughout the year.
Right.
And they have by way of investing in LIHTC developments,
Right.
low-income housing tax credit developments that we do, and to syndicate the credit. And it's a good way for them to get, like in terms of the ESG, some of the
Right.
social good governance,
Exactly.
and people know
But
what
it's
they're
a
doing, a good
win-win.
thing.
And
it's
he
a
made-
win-win.
and he made money.
Yeah, and everybody makes money.
So
And
you made money and you have goodwill. So, yeah.
And that's always a good thing. I
Right.
mean, you're housing folks that need to be housed in some of the low of the low, and they're getting a bit of a tax break for doing so because, as you said, the credits wouldn't be available if the government could keep up with the housing demand.
Right.
Or if the market could keep up. If anybody could keep up with the housing demand, we wouldn't have
Exactly. That's
credits.
right, exactly.
There'd be
So
no
I'm
discount. And that's the
incentivizing-
reality. And so this is a way to incentivize that participation from the market, like
Right.
Amex, like Wally Green, like Visa, like any other fund they put together,
Right.
and even some rich individuals. I mean,
Right.
some funds are amassed of wealthy individuals who have a humongous tax liability,
Right.
and they feel that instead of giving Uncle Sam all their greenbacks, they'd rather pay cents on the dollar and sort of do a good deed, which is
Right,
provide
exactly.
some housing. So, yeah.
Exactly.
All right, and how are those projects usually structured?
They're usually structured in a GP LP structure. It really depends. Different syndicators, some of the bigger syndicators out there, Raymond James, the Richmond Group, PNC, Boston Capital. It just depends on how they would like to set that up, and it really depends on how their fund's set up.
Yeah.
See, their fund, before I even win an allocation of tax credit from any state, the fund that's going to buy my credits is already formed. So it can be formed
So
as LLC or LP, just depending on how they have that formed up. Yeah.
And then is there, like, once you get it structured, are the economics can you explain the economics of
Yeah,
of the
I mean-
arrangement, like from a partnership perspective? Say you got the development side and you have tax equity coming in. So how is the economics? Because you have operational income losses, but you also have the tax credits, which is important in tax equity.
Right.
So how is that structured over the life cycle of the fund?
deal? Yeah. Up front, essentially, the equity provider is giving you a guarantee of providing so much equity to get your deal done. So you're gonna have to get a construction lender involved, which uses the equity provider's guarantee that they're gonna come and take the construction lender out. So that makes the construction lender whole. He's good to go. You also have a permanent lender In most cases, you might deal with a nonprofit permanent lender that's going to give you a better than deal interest rate. So you have the equity, you have the perm lender. So that sets your development to get all the completion. Now, once you get to stabilization, that's when the fee arrangement comes in, because part of that equity infusion is developer fee. You have a fee to put the whole deal together. And depending on what state, what set aside you work in, it can be anywhere from 13 to 18% of what they would consider the TDC, which is the total development cost. That's when you encompass the land, all your soft costs, which would be your architect, your financing costs, all those things that are soft, and then your hard costs, which is your actual building costs, the funds that you would get to your GC. And so once you have all those costs, you have your soft costs, you have a hard cost, you have your developer fee, you're being paid out as the development sort of goes along. And so typically what happens is, because you have an allocation of credits, which the syndicator can use right away, the second the partnership agreement's signed and they come in, they usually kick you off a little bit of developer fee. And this may be 9 months before you actually start construction, because you may be at a point where you're still getting your architectural drawings done, you may be working with the GC to kind of maybe reduce cost. And so at that point, they're in it for the long haul, right?
Right, yeah, you're in it now.
How long?
You're in it.
When do they usually get bought out?
Well, it's a couple of different things. It's how you structure your limited partnership agreement with them is when they exit. And so if you've been in it a while, and depending on how savvy you are, you can really have a put in the LP. You know the put interest in, because you're an attorney. I'm sure you understand what the put interest, and just the interest saying they'll put their interest to me for a dollar amount that we set up when we do the LPA, which can be nominal if you think about it, right? It can be very nominal, because once they get the credit infusion, they take all the benefits from the credit. Amex and PNC, they don't want to own real estate. You know, exactly. Amex is a credit card company, and PNC is a bank. So they don't want to have the assets. And once they get the utility out of it, then you can negotiate through the limited partnership agreement, which is signed up front, how that's going to happen.
So
and it's a number of ways. It's a number of ways it can happen. It's just how you want to kind of structure it. But and it's funny that you asked that question. It's a great question, because that actually has to do with how much equity they want to give you up front. It's sort of like a cat and mouse game. You know, you may need 90 cents on the dollar for your equity to make the deal work, and you also want a put option for 10% of their tax basis at the time. And that may or may not work for them. They may say, "Look, I'll give you 87 cents on the dollar for that same. If you need if you can only pay 10% of my tax basis for me to put my interest to you." And so that's just negotiation.
Do you guys do special allocations and within the partnership agreement? You know, like, so tax equity gets 100% or 95% of the tax credits, 100, whatever it is. But then, you know, the developer gets 100% of the operating losses. That's going to be allocated to you on the K1, or is it 95.5? So that's what I've typically seen.
Yeah, it's
in the renewable
typically
space.
It can be anywhere. It can be typically they get 99% of the tax losses, and they're not interested in the income that's derived from it, because it's a tax credit deal. So it's set up for them to get 99% of the tax losses, typically us to get 100% of any income that's kicked off until that put option gets enacted in year 15. The IRS code, which is section 42, and this guy knows the whole IRS code. I just know section 42, and you know how many sections, you know how many sections they got. I just know 42, and that's it. But in terms of that, in terms of that, they take 99%. We take 0.1% of the losses, which on the K1s can be, the losses are significant on year by year.
Which doesn't get that,
on your ordinary income, they are. They're pretty significant.
And they get the losses.
And they get losses for the 10 years. For the 10 years.
So it's a 10-year flip.
It's a 10-year flip.
And then it flips to y'all. You guys get 99.
From year 11 to 15, typically your LPA has some type of mechanism to start to get them to unwind, and they want to be out. The state agencies make them, by virtue of the Section 42, stay in for 15 years. They have a 10-year credit they get year over year, and they have to stay in those extra 5 years just in case the project is upside down. And so they'll be the first person, obviously. The developer, I don't have very much money. They'll be the first person we ask as the 99% equity owner at the time to say, hey, this thing, you know, it's not doing right. We need a cash infusion.
Yeah, that's interesting, because in renewable projects, you'll have the developer and you have tax equity, and tax equity will get the credits, and you'll have the developer that would be allocated some losses, and they have a deficit restoration obligation drafted into the partnership agreement, which means I'm putting in the project, they're putting in the money, and on my partnership rules require you to have put in capital to get losses. But if you have a DRO drafted into the partnership agreement, you can deduct losses in excess of what you put into the partnership. Because
even if it's not real equity.
Even if you ain't put the money in yourself, you can deduct losses that someone else put the money in. There's losses generated in the partnership. You allocate them to me.
Yeah.
I deduct them on my tax return because we have a DRO, and how we track our capital accounts.
Yeah.
That's why I love partnership tax so much, because it's contractual and flexible, and renewable projects are typically structured that way because, as a developer, okay, I have a benefit, and then they just want the tax credits.
Right.
That's all that's
yeah.
And then the losses, I can take those.
Right.
But then the DRO, to the extent that you take losses in excess of what you put into the partnership, if the partnership were to dissolve, then you would have a gain triggeration event.
Right.
Because so most of the time DROs are limited to 30% or 10 million. At some point, we're not taking no more losses.
Right.
We got some losses. Thank you.
Right.
And now it goes to tax equity because we don't want to, we don't want to be on the hook to true up the accounts. At the end of the day.
Right.
So that's something that y'all can think. Obviously tax equity. I mean, they're getting the best of both worlds. But now y'all getting what's different in structure. There isn't that development fee. You know what I'm saying? So now,
and then, let me
that's how y'all get
also
paid.
in that the renewable energy space, I'm telling you, in year 15, I can get you out. I can get you to put your interest. I've seen interest be put on a 64 unit deal in LA for $100, 99%. The development company I work for, we had 01%. We're the developer and the managing general partner. The year came around, and we got all that for a nominal fee, and hardly no debt. It's worth it. It just went crazy. Their capital account terms went crazy. What it's worth from when we started, and so that's one of the things that the benefits of sticking in there and sort of self-managing at some point where you get an opportunity to have a bigger portfolio, because you can have those opportunities to either get them out and take it out the program, which is the tax credit program, which is not sometimes the best thing to do, or you can re-syndicate it and run the taxes back again and do a tax credit development again on it. And when you're 15, 20 years in, 15 years, a lot of these projects have useful lives of 30 or 40 years, but depending on how bad the population tenants are, it can be a lot less, depending on what you have in your replacement reserve account. You may not have enough to cover it, and so it's just ways you can. So the re-syndication is a play you use at year 15 to basically put credits back again.
Right. And that's why I came out here. So I can learn something for sure.
That tax law.
Yeah, that's dope.
So now, Justin, from your perspective, hearing, I will call maybe other sections worth of IRS code information over the last, I don't know, maybe 10 hours today, and a couple podcasts worth from Karl. What are some of those things that maybe some of the folks in your circle, whether they're other real estate professionals, like people in the group that you're at, your family that I know that's in development, what are some things that you might say, okay, look, here's a nugget that we need to further dig into, maybe with that?
Well, I think that biggest nugget is that bonus depreciation. I mean, that's no joke. Even, folks own, one or two, and again, just not being that real estate professional, and they'd have to reach out to Karl to really understand how they're going to do it. But I think that's a great nugget, and again, it's one of those things where if you're not reading those codes, which, let's be honest, if you're not like a tax nerd, I'm not reading those codes. I mean, that's your job and you're smarter, but I'm not. I mean, I know business folks. We got a businessman behind me. I'm sure he hadn't read that code.
Right.
I mean, you get so trapped in trying to run your business and, manage your family and manage everything. It's like you miss those little nuggets. And so I think just listening to last and listening to that podcast that he was on, Karl was on, that's one of the things that I'm taking back for, you know, me and my wife, because, you know, we have, aside from the tax credit portfolio that I'm partnered in, we have a small portfolio too,
Right.
and
something
we're sleeping,
like
so that's a big
I
nugget.
think you're a real estate professional for sure.
Yeah. Oh yeah. So
and to the extent that you haven't taken a bonus or done a cost seg, I think you go back like 15 years.
yeah, I'm gonna be looking back.
And you can do it all in this year. If you haven't filed your 2022,
Right.
and you make significant money there, maybe do it in 2022.
Yeah, that's right.
Right, because you get 100%, right, and then it'll carry forward. Even if you don't have significant income in 2022, it's better to do it in 2022 so you can get 100%
of it, right?
Yeah, because that's about to phase out.
Yeah. Okay. All right. Now I had a question about that. If you get to the point where you had enough bonus, would it carry forward?
Carry forwards indefinitely.
Okay.
Yeah.
So if it ate up all your ordinary, it could carry forward. So you want to get the 100% right away.
Carry. Yep.
Okay.
Yeah, and you'll get it, but you should do the cost seg. Do the cost seg,
Right.
and then the engineer will break down an itemized list of what your property components are in their useful lives, and the cost allocated to that asset
Right.
class.
Well, I got another question for you. So if I call an engineering, if I Google cost segregation, Phoenix, Arizona, or San Diego, and I pick up the phone and try to tell them, you know, sort of, you know, bobble through that lingo you was telling me, they would understand exactly where I'm coming from, what I'm trying to, my end goal. I mean, I wouldn't be spinning my heels. I say, hey, I'm looking for a cost segregation because I own this as a rental asset. I'm looking for some bonus appreciation. Do you know what I'm talking about? I mean, they say, hey, we're right on it. It's going to be this amount. We'll be right out. Or is it specialist that you got to get to?
Phoenix, Arizona is very savvy in real estate deals, as we've seen in the housing bubble. So I think you have plenty cost segregation engineers. They're in Phoenix, Arizona. I mean, you can call it BDO, KPMG. You can call it the Big Four because they all
do it.
Yeah, and even inside the top 10. But then there's those independent engineers that are not just in Arizona. So I have an engineer she's in Texas and DC, but she can do a cost segregation study anywhere in the world. She's done some for me or my clients in Miami. Okay. She's in Texas. Okay. And one is in so my client's in California, but they own a property in Nevada. Right. She's in a cost seg for them. And it's all about the product, right?
Yeah,
so,
finding out who's going to work best.
Her reports are amazing. So if you get with a KPMG or a BDO or something like that, they're gonna, of course, know what you're talking about.
2 minutes. 2 minutes. All right, so I got one quick question for you. This is kind of switching gears and going more towards around how will entities invest money. And so I recall there's some ways that, especially for larger, you know, maybe corporations, or, you know, even family funds, whatnot, where they can bucket dollars that will allow them to invest in other people's projects in a tax efficient way versus just writing a check out of their account. Am I making that up? Is there something in that space where I don't want to call it a self-directed IRA equivalent, but some bucket that will give corporations or people with sums of cash on hand that need a more efficient way to invest it in other third-party projects, like a real estate project that I might be running.
You asking me?
Yeah, that's more of a question.
Okay, are there ways that corporations can invest their money more tax efficiently into real estate development projects? Obviously, of course, the use of tax credits, of course, the bonus.
Right.
Outside of those tools, like real estate is a tough one because we just laid out the path to real estate. But if you have opcos, right?
Okay.
I just did a presentation on Section 1202, and maybe I'm not getting to what you're talking about.
No, but I think you are. I think 1202 is one of the ones
Section 1202. So if you invest, I'll make this real quick. It's called the Qualified Small Business Stock Exclusion, and a lot of people don't know about it right now. But it's going to be very important coming up, especially if the corporate tax rate goes to 29% or 39%. So the QSBS allows an individual, as long as the company qualifies. If you when you sell and you exit that business, you can exempt up to 10 million, the greater of $10 million or 10 times your basis in that project.
Okay.
So you can't be real estate focused.
It cannot be.
It cannot be. Can't be service focused.
It needs to be opco.
Like lawyers can't. It won't qualify.
That's what manufacturing.
Manufacturing will qualify. So you set up a QSBS company as long as you just add gross asset test. So as long as you bought your stock from the corporation, and when you bought it, the after purchase value doesn't exceed $50 million. We have to test, whether its actual operations qualify. You presumably have 1202 stock. So when you sell it, if you sell it for $10 million, you pay no tax. Let's say if you bought it for $1 million and sold it for 10,
Right.
you pay no tax. It's 100%. So if you acquire stock after 1993, let's say, I think it's September 1993, don't quote me on that, but a date 1993, it was 50%. Then from 1993 to 2000, after 2010, it went up to 60%, and then it phased up to 100%. And that's to encourage investments in small businesses and startup companies. So all these SPACs, mergers and SPAC public offerings that you see, these people are making out, bro.
Right.
For
So
real.
once they get
They're
the
making out.
hockey stick economics, 10x of what their basis was, they're not even paying any tax.
1202 is going to boom. Like in the coming years, if we see a change to the corporate tax rate, right, or we see an increase in the corporate tax rate, and that's so they want to increase the corporate tax rate across the board, but they haven't addressed the fact that you can exclude gain on the QSBS. So now people are going to start coming to me
They're
and
going to
saying,
exploit that, basically.
"Oh,
That's what you're
they're
saying.
going to tear it up for a little while."
Right.
Until they catch up. Until they catch up, right? Until they catch up.
Yeah. Yes, and Stuart Clemens and myself just did a presentation on Section 1202 at a tax forum, because I am a tax nerd, on my firm's tax forum this past Tuesday.
You got to get us a link on that.
I'll get you the link. I'll send you the presentation.
Yeah, we'll make sure it gets on something.
Yeah, post that out.
No doubt.
People want to see that.
Okay.
Yeah.
So that's good stuff, man. So appreciate Karl, appreciate you, Justin, coming out here, talking with Well Mentality here at the Well Pod, as we call it in San Diego. It's always good to not only sharpen the iron with folks in the same sector, but then how that bleeds across for people just hearing and listening and rubbing in the same circle with you on, hey, look, that might be a nugget that I need to take back. So tax, I think, is very specialized.
Yeah.
Again, a lot of people don't know about it. You guys are much more on the learning curve than most. But even others, just knowing that, hey, look, they're dabbling in that same type of thing, they're going to pick up the phone. So appreciate both y'all again. More to come.
It's a pleasure.
Yeah.
I'm sorry.
I appreciate you.
It's my pleasure. Like, there's not a lot of overlap, so I'm learning from everybody here.
Yeah.
And that's why I'm happy to be a part of this group. And I'm anticipating a lot of success coming out of this group. So.
Yeah, that's right. We're about to bleed some of that win.